What is up, guys? Happy New Year! Can't believe we're already in 2024, which is crazy, absolute bananas. Super excited as we gear into a brand new year, gear into a brand new quarter. We've been blessed with the opportunity last year to grow our business substantially, and we're at it, we're grinding, we're putting things together, and super excited to share with you guys. Again, we're going to be hosting these home buying seminars and these weekly market updates consistently every single Monday, really around 5 o'clock, 5:30. I'm thinking we'll go live and we'll go over a lot of different aspects of what are the things that are happening in the market last week, and what are the things that we're expected to transition into this week and the following, right? So again, obviously we know, going right into it, the markets were obviously closed, over the holidays. It was closed for Christmas. The latest housing report showed what, right? So the last home sales showed that home sales are projected to improve heading into next year, heading into 2022, right? Pending home sales did not change from October to November, and October's figures were revised slightly to show again that home sales were still 5.2% below what they quote unquote had projected, right? Now, what this data does specifically is this data measures signed contracts. Okay. So, what we're going to go look at is a lot of the different avenues, and I'm going to zoom in here so you guys can see. The index again shows a 71.6. What does that mean? That showed that as falling interest rates started to occur, right, we started to see a little bit more openings in terms of inventory, and we started to see a little bit more openings in terms of just overall volume that we were kind of simultaneously looking at, and taking it from there. Okay. Now, again, contracts were relatively flat October to November, right? It's usually always, this is backdated by 2 months. But we did see that declining interest rates played a major factor. And one thing I shared earlier last week was Case Shiller came out. Case Shiller is one of those reputable resources that monitors exactly what I call, you could see it here, the gold standard for appreciation. And it showed that nationwide home values jumped up 0.6% from September to October, right? This is the ninth consecutive month that we've seen those positive gains, right? Now, the prices were bouncing anywhere from 4.8% to roughly about 5%. We're still consistently seeing that high increase of literally almost 5% from the prior year. And this is on a national level. I'll be honest with you guys. For those of us who are in New Jersey or Florida or anything in that market, the home values actually were substantially higher, and the values were simultaneously higher as well. Right now, the FHFA, which is the Federal Housing Finance Agency, they monitor both cash transactions and finance transactions, and that showed that home prices appreciated 0.3% in October, once again setting new record highs every single month since the second month of the year. Now, again, with the FHFA, like I mentioned to you guys before, what they do is they also represent, lower priced homes at the same time. It does not include cash buyers, or I flipped it, right? So the FHFA does not include cash buyers or jumbo. Case Shiller does. That's why sometimes you're going to see a little bit of a difference. But regardless, however you want to look at it, we're still on pace, right? Because we have 1 month back. We're still on pace to see that last year home prices appreciated by 7%. They saw a massive uptick in terms of home price appreciation, which again led to indexes that we get to monitor, and again led to indexes in terms of different comments that we're able to see for, of course, the opportunity of gaining home ownership and presentation. Right. Then we saw continuing jobless claims. So this week is the employment data week, right? Tomorrow we're going to be getting the updated reports from the JOLT report, which is the job openings and labor turnovers. How is the market going to react? Are we going to get another friendly reading? And rates right now they just shifted to the highest they've been in the last 2 weeks, right? So we really want to kind of see, how is the employment market ticking? Is the employment market, has it finally cracked? And if it did, we're going to continue being on that downward trend as most of us have done, right? The crazy part is the smallest data reading, and that's why it's just uber critical for us to stay on top of that stuff. The smallest data reading could potentially shift interest rates back to high sevens, or could potentially shift interest rates to high fives, right? Which is a little crazy to see, but that's the reality of what we want to make sure that we're staying on top of that stuff and setting proper expectations, right? Clients are going to have the ability now to qualify for a little bit more. God knows how many clients came to me. Literally today, I talked to an average of at least 10 to 15 new clients daily, and we're still seeing eligibility issues, right? In terms of affordability, right? Income's not there. We have to add a cosigner. We have to add a non-occupying borrower, whatever the strategic avenues we need to employ, which we will. But we want to make sure at the same time that we set those proper expectations, and those are the different avenues that we'll do, right? Now, again, what we're also seeing, again, with this low number of initial jobless claims, what it's starting to suggest that we're starting to see a little bit of an uptick in terms of layoffs, right? And that's what we're going to find out this week. With the JOLTS report tomorrow, along with the ADP report, which measures private employment, and then we're going to get on Friday the BLS report, the Bureau of Labor Statistics. That is one that always has the ability to shake the market, right? And it shakes the market either in a positive progression, like we got the last 2 months, or what we got within the last year and a half is a little bit of that slight shift in terms of home values and in terms of where interest rates would go, right? So again, recapping once again, the market was closed yesterday, obviously for the holidays. What we're going to expect is the JOLTS report on Wednesday, starting tomorrow. That is job openings and labor turnovers, how many jobs have been created versus how many jobs are currently people being turned over from, being let go. Then December, we get the ADP report, which, as I mentioned, measures private payroll and private numbers. And then we'll get generally the weekly jobless claims, as we usually do on Thursday. And Friday, we'll get that, big December jobs report from the BLS, the Bureau of Labor Statistics, which once again monitors both non-farm payrolls and the unemployment rate, like you guys see, right? And if we kind of see more or less here, how is the housing market kind of in terms of rates kind of doing, you guys can see here from our friends over at MBS Highway, we're starting to see. So whenever there's a negative, and this is called mortgage-backed securities, whenever there is a negative, that means that interest rates are slightly going up, right? And the thing we want to monitor at the same time is you see this massive uptick, which usually I always say right before Halloween, right? Mortgage-backed securities went to almost as low as 96%, or 96 was the coupon, which is pretty crazy. And that's why we were seeing interest rates at the 7s and the 8s, right? What we'll see now, as you guys are starting to see, is interest rates for literally the last 2 weeks have been relatively flat. Literally, we've been right under that ceiling of right over that 101.392 ceiling that you guys are seeing for the last 2 weeks. And what I'm generally seeing based on Mortgage News Dailies and other trusted sources and just stuff that we're locking, the average consumer is usually at a 6.5 to a 6.75% in terms of rate and stuff like that. So we're kind of staying a little plateau to that. So those are the things that we really kind of are monitoring to see what are the various different changes. And then we'll also see on the 10-year Treasury note, right? That is also a massive impact. And once again, since October, right, this has a direct correlation too. So as the 10-year Treasury starts to reduce, interest rates start to reduce as well. So we kind of keep an eye on that. The good thing is we were almost breaking just close to almost 5%. And I think we actually did break close to 5%. So the good thing is, again, is that we're able to simultaneously obviously get around that, which is why we're kind of teetering right under that ceiling of that 3.92 of what we want to kind of stay away from, right, before interest rates start to tick up as well. But yeah, that's about it. I appreciate you guys jumping on. I will post this thereafter on YouTube and all the other social media channels, and we'll take it from there. Have a blessed day, guys. I'll talk to you guys next week.